Imagine waking up tomorrow and suddenly receiving $100,000. Maybe it's a bonus, inheritance, or profit from selling a business within minutes. You face a decision that feels simple, but silently shapes your financial future. Do you invest? Everything right now, or slowly spread investments over time to feel safer? Most financial voices online will give you the same answer. They'll recommend dollar-cost averaging, invest gradually, reduce emotional risk, avoid bad timing. It sounds rational, responsible, and safe over time. This advice became almost unquestioned truth repeated across books, videos, and forums. But what if the strategy that feels safest is actually mathematically weaker? My name is Benny, and I spend a lot of time studying investment data that challenges common financial beliefs. Today we're breaking down why lump sum investing historically outperforms gradual investing around 70% of the time, and why the real risk isn't market volatility, but lost time. People love dollar-cost averaging because it protects their emotions. Nobody wants to invest a large amount only to see the market drop the next day. DCA creates emotional protection by spreading risk across time, giving investors the comfort of not buying at the exact peak. But emotional comfort has a price. When you delay investing, a large portion of your money stays idle. That means no compounding, no growth, and continuous erosion from inflation. While you wait for safety, your capital quietly loses momentum. Markets are imperfect and volatile, yet historically they trend upward over long periods. Keeping money on the sidelines doesn't eliminate risk. It replaces market risk with guaranteed loss of purchasing power over time. Historical data shows markets close higher more often than lower. Choosing gradual investing over a year is essentially betting that a crash is coming soon, a prediction that statistically fails most of the time. The true superpower of investing is time in the market. Compounding works best when capital is exposed early. Delaying investment reduces the time available for growth and removes the strongest advantage investors have. If markets rise during your waiting period, which happens frequently, you miss gains that could compound for years. The hidden danger isn't short-term volatility. It's long-term opportunity cost. There is one scenario where DCA feels powerful: investing right before a major crash. Watching markets drop after a lump sum investment feels painful. This fear drives many investors toward gradual strategies. Yet long-term research reveals something important. Even when lump sum investing loses early, it often regains the lead within a few years because more capital was invested earlier. Buying more shares overall. Think of buying an entire apartment building before a temporary downturn. Values may fall initially, but ownership of more assets allows stronger recovery when conditions improve. The solution isn't blindly choosing one method. It's understanding your time horizon. Money needed soon should not face market volatility, but long-term capital requires a different mindset. If funds are intended for goals 5, 10, or 20 years away, maximizing exposure to market growth becomes statistically logical. For investors uncomfortable committing everything at once, a structured compromise can balance logic and psychology instead of spreading investments across an entire year. Deploy a large portion immediately so compounding begins early, then invest the remaining capital over a short, predefined schedule. This approach reduces emotional pressure while preserving most of the mathematical advantage of early market exposure. One of the biggest myths in personal finance is believing safety guarantees better outcomes. Many investors prioritize emotional comfort over probability. Gradual investing feels protective, but strategies designed to reduce fear can limit growth over long time horizons. Markets tend to reward participation rather than hesitation. Most people think money is their greatest asset, but time is more powerful. Compounding needs duration to work effectively. Everyday funds stay uninvested represents lost opportunity that cannot be recovered later. Small delays may seem harmless, yet over decades they can significantly change final results. Investment risk is often misunderstood. Many define risk as short-term volatility, but real danger is failing long-term goals because capital stayed idle. Market swings feel dramatic, while hidden risks like inflation and missed compounding quietly reduce purchasing power over time. Investors often wait for perfect timing, hoping certainty will appear. Markets rarely provide clear signals without uncertainty. Success usually comes from consistent participation and discipline rather than precision timing. Acting on probability instead of emotion helps capture long-term growth trends. Viewing decisions through a long-term lens reduces the emotional impact of short-term fluctuations. Markets cycle between optimism and fear, but history shows overall growth. Focusing on decades instead of months transforms investing into a structured process based on patience and consistency. If this changed how you see investing, that's the start of smarter decision-making. Progress comes from questioning common advice and understanding deeper market mechanics. Give long-term capital time, structure, and disciplined exposure. Subscribe for more insights on building stronger financial strategies.